Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking all about Bitcoin ETFs. Bitcoin ETFs have been in the news a lot recently because several of the biggest asset managers, BlackRock, Fidelity, and a number of others, have submitted new filings to bring spot Bitcoin ETFs to market. This is a little bit different than what exists on the market currently because spot Bitcoin ETFs mean that the fund actually holds Bitcoins in trust somewhere behind the scenes that shareholders are entitled to. The SEC has been dragging its feet on this and reluctant to approve such filings for a number of different legal reasons over the last few years, but it appears like the ice is starting to thaw and the SEC is leaning more toward approving these things sometime in the next 6 to 12 months. If that happens, there are a couple of implications for investors like you and me, and I wanted to spend today's episode talking about the nuances and what we need to know about it as investors. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the podcast, we are going to be talking about some people's most favorite topic and other people's least favorite topic, and that's Bitcoin. And the reason that I wanted to cover it in today's episode is that over the last couple of weeks, there's been a lot of headlines being made about different asset managers making filings and amended filings to bring Bitcoin ETFs to market. And this has the potential to be a relatively major event in the course of Bitcoin and its evolution, and this lingering question of whether it has intrinsic value and is something that we should be paying attention to for a number of different reasons. And so today on the show, I wanted to dive into where we are with this, why we should probably be paying attention to the status of these Bitcoin ETF filings, what they are, and whether or not it makes sense to invest in them, to be totally honest. So to start, we should probably talk for a minute or two about what's on the market right now, because there are a few Bitcoin ETFs that exist that you can go out and buy over the counter in any ordinary brokerage account. And the two that have the most assets in them, and I believe that there are only two that have been approved by the SEC. There may be more. One of them is a closed-end mutual fund that's managed by a company called Grayscale, and the ticker is GBTC. Now, a closed-end mutual fund is different than an ETF, and it may actually make the most sense today just to refresh everybody on the differences between a mutual fund and an ETF. If you've listened to a bunch of the episodes on the of our podcast, you've probably heard this story before, so forgive me if this is redundant or repetitive. But this is a fundamental difference that we need to be aware of. And in an ordinary open-end mutual fund, you as an investor give money to a mutual fund manager, they take it, and then at the end of the day, they determine what the portfolio, what the fund that you're buying is worth based on net asset value. So if you have, let's say, a mutual fund that only contains shares of Tesla stock, then at the end of that trading day, they're going to determine what Tesla is trading for, and that's going to be the price per share of the fund. And so if you give them $10,000 to invest, they'll divide that $10,000 by the value of the fund at the end of that trading day, and then you will, in return, get an equivalent number of shares. So you get the amount after factoring in the net asset value for that day. Now, realistically, I don't know of any mutual funds that have just one stock in them. They all have hundreds and thousands and tens of thousands of different stocks. So it's a little bit more complicated than that. But in an open-end mutual fund, there are assets in the portfolio, and the managers are constantly entertaining redemptions and new investment requests. They're taking money from investors, issuing more shares, taking that cash and then investing it in the portfolio the following day. And then they're also issuing entertaining redemption requests. If you have shares and you want your money back, you ask to redeem them to the mutual fund manager. They say, okay, that's great. We'll figure out what our fund is worth at the end of the trading day, and then you get your cash back or number of shares. You can do it in either direction once they know what the portfolio is worth. Now, sometimes what happens is these open-end mutual funds will close to new investors and become what are called closed-end mutual funds. And so here, if you want to buy a closed-end mutual fund, you don't interact directly with the mutual fund manager. You purchase it in a secondary market. And so when a mutual fund closes, that means that the manager is not entertaining redemption requests at that time, but they're also not issuing new shares of the portfolio. And they move the shares onto an exchange so that they can trade in the secondary market. And so if you have shares and you want out, the mutual fund manager isn't going to entertain your sale request. You have to find somebody else to purchase it from you. And there's more formalities than that. Mutual fund managers can't just drop the hammer on their investor base out of the blue. I know that there's a whole lot of disclosure and communication that has to happen, but that's the main difference. Closed-end funds are not taking new money into the portfolio. They're simply changing hands in the secondary market between people who own the shares and people who want to buy more of them. The fund itself, so the underlying, in this case, Tesla stock, the same number of shares of Tesla stock still sits there. So what's currently on the market for Bitcoin is a closed-end fund managed by Grayscale. I mentioned the ticker is GBTC. And the fact that there is a closed-end fund that people can invest in has been a really, really interesting phenomenon. Because what will happen in closed-end funds over time is, so in this case, the mutual fund manager, Grayscale, has purchased a bunch of Bitcoin and put them in some kind of trust. And there are a number of ways to structure these trusts. Usually they're structured as grantor trusts. And so when you purchase shares of the mutual fund, you have a right to some of the assets, a pro rata portion of the assets inside that trust. And then for their efforts, the mutual fund manager charges a fee, which is usually a percentage of assets. In the case of this security, Grayscale charges 2% of the assets for their management fee every year, which if we're comparing this to the rest of the universe of mutual funds that holds more traditional assets like stocks and bonds, that's like the most expensive there is. There are probably mutual funds out there that have higher management fees than that, but 2% is very, very, very high. Most mutual funds that we want to consider buying these days are substantially less than that. Maybe 0.25% per year or something like that. So for their efforts, they charge 2%. It's a very, very expensive endeavor. The benefit is that when you purchase shares of the fund, you have that manager that's holding those Bitcoins in trust, I believe, and hopefully off of the exchanges. You don't want to have a situation like FTX where your shares or where the assets that your shares have a right to just kind of disappear because the exchange went bankrupt. Grayscale is taking care of all of that on your behalf. And so it's easier to buy in a lot of situations. Now, the issue with it is that the price at which this security will trade is based on supply and demand for that security. So there's a bid and an ask spread, like when we buy an individual stock. And oftentimes, particularly with this closed-end fund, the security itself will trade at a substantial premium or discount to what the underlying assets are worth. So you think that, let's say this thing is trading at $100 a share, and that gives you the right to a very small portion of one Bitcoin based on what's in the trust. Well, you would think that the value of that Bitcoin that you're entitled to by virtue of owning the share should be worth $100 too. Well, the value of the one share of the closed-end fund has varied over the last few years and swung wildly between a premium and a discount. A premium meaning that that a share of the security of the fund is far greater than the underlying value of the Bitcoin being held in the trust, and a discount meaning that it's trading at far lower than the underlying value of what's in the trust. So it's a drawback. And ETFs solve that problem by having authorized participants transact in the underlying security. And I'll get into that in just a moment. So the grayscale fund that's out there is a closed-end fund. It's expensive to own, and it swings wildly around the value of what's in the actual portfolio. Now let's compare that, a closed-end fund, to an ETF. If we're talking about something like Tesla stock or the S&P 500 or any more traditional ETF or an ETF that holds a more traditional asset, the structure of an ETF is relatively innovative and it's relatively new. It's only about 30 years old, which is pretty new in the grand scheme of things here. But they get around that problem of premium and discounts because they have this group. When you bring an ETF to market, you have a group of authorized participants. So some of the Wall Street trading firms, they sign up to be authorized to create and destroy shares of the ETF. And so in the example of our Bitcoin closed-end fund, if the value of the shares of the fund are greater than the value of the underlying asset, that's a problem for holders. And if you're the manager, you probably want the value of the fund to most closely resemble the value of the underlying asset. Because if the shares are greater than they should be because they're trading at a premium, it's a disincentive for people to be involved in it, and maybe more likely to fall in value back closer to what the underlying asset is worth. So if this were an ETF, an authorized participant would have the ability and the expectation to create and destroy shares to take advantage of that difference in pricing. And so if you're a trading desk somewhere that is an authorized participant in such a security, if the value of the fund is trading at a premium and exceeds the underlying value of the assets, what they'll do is buy the underlying assets, sell the fund short, betting that it's going to go down. They'll take the underlying assets and create new shares of the fund that they've just sold short, deliver the newly created shares to satisfy their short sale and close that transaction out and profit from that difference. And so there is an arbitrage opportunity here in ETFs, which is the entire reason we have this network of authorized participants when you bring an ETF to market. ETFs have, I believe, anywhere from like 8 to maybe 16 or 20 different authorized participants for their shares, circumstances depending. That mechanism simply doesn't exist in a closed-end fund. And I don't know all the legal reasons that why this grayscale fund was able to come to market where other mutual funds haven't, but I suspect that the structure of being a closed-end fund had a heck of a lot to do with it. So those are the main differences between closed-end funds and ETFs. Now, the other product that's already on the market is an ETF that is based on futures contracts. And so this is a structure that we see often in the levered and inverse ETF world. So we talked a few months back on the podcast about single stock ETFs and why they might not be such a good idea for most people. You can buy an ETF that represents only one stock. Tesla is one, for example, but it's levered. And if Tesla goes up by 2%, the value of the ETF will go up by 4%. And if Tesla falls by 2%, the value of the ETF will fall by 4%. So it gives you leverage based on the volatility of the underlying asset. Well, we've used this example where if you're going to create an S&P 500 ETF, you go buy the 5 shares of the 500 underlying companies and you put them in a trust. You're buying them on the open market. You put them in a trust, package them up, and then you create shares of this ETF out of the thin air, basically, because you're an authorized participant and have the right to do so. And then you sell shares of the ETF with the underlying stocks held in trust as collateral out on the open market. Well, these leveraged and inverse ETFs and the Bitcoin, BITO is the ticker here, those are all based on futures contracts. They're not based on holding the underlying assets. And when you hear or read headlines about spot Bitcoin ETFs being considered, spot means they're holding the underlying asset somewhere. What exists right now is based on futures contracts. And so the manager has purchased or sold futures contracts with some derivatives trading desk, another one of the Wall Street banks somewhere, to give investors in the security, in the ETF, exposure to what they're trying to accomplish. And so if you buy shares of this BITO and you can buy them in any ordinary brokerage account that sells right over the market, very easy to buy, you don't have a right to any underlying Bitcoin that's held away in a safe somewhere. You have a right to the returns in that security, which are driven by the value of a futures contract sitting somewhere in the derivatives world. So if the value of Bitcoin goes up, the value of that futures contract will probably go up too. But it's not always a one-to-one relationship. And the futures contract that supports the security that you and I can buy is not permanent either. It's set for a specific term. A lot of these are overnight futures contracts. A lot of them are farther out than that. 1 month, 2 months, 3 months, perhaps. I'm not entirely sure how a lot of these are structured these days, to be honest with you. But what I do know is that when the futures contract expires, the manager must then go negotiate and arrange a new futures contract to replace it with. And that rollover, or that they call it the roll to the new futures contract, really crushes performance for investors in the fund like you and me. And that's precisely why for these single stock ETFs, for these leveraged ETFs, these inverse ETFs, if the S&P falls by 1%, then the value of this security will go up by 2%, something like that. Those are not meant to be held over a long period of time. Those inverse ETFs, I believe, are rolled every single day in order to maintain the structure that it needs to maintain. And if you hold it overnight, you lose value for no economic reason. The S&P may have remained totally flat, but you could have lost a substantial amount of value because of the newly negotiated terms of the next futures contract. So before we go too far down the rabbit hole here of all the technicalities, there are 2 securities on the market that represent some kind of stake in Bitcoin, but they both have issues with them. The closed-end fund version trades at a wide discount or premium, just depending on the month. And there's not a whole lot of guarantee as investors that what we're purchasing will match or even closely resemble the future performance of Bitcoin because of those sways. And on the other hand, you can purchase the BITO, the ETF, but then you're going to get crushed on the roll between these futures contracts as they go on. So there have been a number of asset managers who have been trying to create spot ETFs in Bitcoin for a long time. And you'd think that that would be a more direct and traditional way to do it. Why haven't these things existed? Why don't we have them yet? Why are the only products available ones with these huge limitations? The reason is that the SEC hasn't approved the filings. And the main argument that the SEC has, as I understand it, is, and again, it's a far more straightforward way to structure such a security, is just to go the traditional route, buy some Bitcoin, stick it in a trust somewhere offline that's safe, create this network of authorized participants that can create and destroy shares, and then off you go. New people can purchase the shares over the counter. If there's a substantial discount or premium, the authorized participants jump on it and arbitrage away the differences to maintain some price stability relative to the underlying asset. It's a much cleaner way to operate. The SEC has argued repeatedly that the exchanges for Bitcoin, so I'm thinking of, it used to be FTX, no longer, Coinbase, and maybe Kraken and a few of the other major players here, they're not regulated by the SEC. And this is part of what the huge fight in Washington is all about, is these platforms that make markets in Bitcoin are unregulated. And therefore, the SEC can't guarantee any kind of price stability, and they can't guarantee, well, maybe price stability is not the right way to phrase it. They can't guarantee that the pricing coming out of those exchanges on which authorized participants would be interacting and transacting, they can't guarantee that the pricing is reliable, nor can they guarantee that the markets of these things are not being manipulated, because they're simply not governed under the purview of the SEC. And so for that reason, they haven't approved any of the filings for spot Bitcoin ETFs. If there's no reliability in the pricing of the underlying asset, it's pretty hard for them to approve this. And the argument from one of the arguments from the investment community, the counter arguments, I should say, is that gold was the exact same way when that started becoming more widely traded on national exchanges. But there's been a gold ETF for almost 30 years now. GLD is one of the first ETFs, and it's one of the biggest out there still. So there are a lot of analogous situations where the SEC has approved such a spot ETFs, but they are being reluctant and kind of dragging their feet in the case of Bitcoin, and for good reason. This is the SEC exists to protect investors, and they are measuring twice before cutting, which I think is sound in this circumstance. So there are a bunch of asset managers that are trying to jump on this. BlackRock is the most notable. That's the one making all the headlines. But on top of that, a lot of the major mutual fund and investment management companies are jumping on this as well. Fidelity, WisdomTree, VanEck, Invesco all have pending filings for spot Bitcoin ETFs. The most maybe notable adjustment here more recently, like in the last 5 to 7 days, I want to say, is that BlackRock amended its filing from a couple weeks ago. They pulled their filing and submitted an updated filing that named Coinbase as I think they called it a surveillance agent or surveillance partner or something like that, which gives them more responsibility to monitor the market of the underlying asset, which is the SEC's huge, biggest problem with this in the first place. So we are getting closer to seeing a spot Bitcoin ETF. This isn't investment advice, as the disclaimer at the beginning of the of the show articulated. But for our clients at the firm, we're not recommending that the two existing products are a good fit for anybody other than short-term day traders. And if a spot Bitcoin ETF comes out, that might be a more legitimate way to access the market as an alternative investment if you're interested. I have a lot of doubts about the current status or the status of the current exchanges out there as it stands. I don't know quite as much about Coinbase, but Binance is another one that's really coming under pressure from a regulatory standpoint. The SEC has all sorts of lawsuits pending against them, and from a capital adequacy standpoint too. I know they've had a lot of outflows, and I would hate to see someone get involved in Bitcoin and then lose everything like so many people did at FTX because they chose to put their money in an unregulated place, and that place just went belly up because of mismanagement or over leverage or greed or manipulation or a combination of all those. So for individuals, an ETF is probably a more legitimate way to access that market. If the spot ETF does come out sometime soon, you can purchase it in a brokerage account basically for free. ETFs are free to buy and to sell. And the manager of that ETF and its corresponding authorized participants have all the responsibility for holding the underlying asset safe. And I don't know I haven't read the filings of what BlackRock is proposing, and I don't know exactly how that would work logistically, but it's their job to store it in a safe place and buy and sell on owners' behalves, owners of the security on their behalf, when shares are created or destroyed. That's all on them. So it's a much more efficient and effective way. And also, once these things are passed, and I'm assuming they're going to be passed, it looks like they're heading in that direction. People smarter than me in this subject are speculating that they'll probably be passed in the next 6 to 12 months. But it puts competitive pressure on the exchanges. So if you or I wanted to go buy $10,000 worth of Bitcoin, you deposit money into one of these exchanges, and then they're going to charge you a fee on the transaction that's a percentage of what you're transacting in. And it's relatively substantial as I understand it. Well, if an investment manager is handling that for you, yes, you have to pay an annual operating expense to the manager for handling it. But if that group of authorized participants is the one executing the transactions, you can buy the ETF and sell it for free over the counter in a brokerage account. That's a far more effective way to handle it, and because it's a huge improvement, that puts immediate pricing pressure on Coinbase and Binance and anywhere else you might deposit funds and then purchase shares of the underlying asset. So it's an interesting thing. The Bitcoiners of the world, the people who are crypto nerds and own a lot of the stuff, are really hoping that these things pass, because then all of a sudden there's a legitimate avenue to ownership for institutions, pension funds, endowments, large institutional portfolios. I think by and large are interested in cryptocurrency and Bitcoin, but uncomfortable with the logistics and holding it securely. If there's an ETF they can buy to where they're delegating that responsibility to the manager, that all of a sudden looks a heck of a lot more attractive and will absolutely result in a lot of inflows. So if somebody out there is owning Bitcoin, if let me put it this way, anybody out there who owns Bitcoin is probably hoping for this to be passed, because it opens up new channels for demand and probably pushes the price up because it's more widely accessible. So that's about all I had for today. I hope this was halfway interesting to everybody. It's certainly an interesting juncture. If these things get approved and come to market, it will result in a lot of money going into Bitcoin. I have no doubt about that. I have no idea what the price of this thing will do ultimately over a longer period of time, particularly with all the pending legal matters that are swirling around the exchanges. I still think these things need to get regulated as banks. The FTX situation is a perfect example of why. And I believe regulators are probably coming to the same conclusion. It's just a legal battle surrounding what the outcome will be. So I hope this was interesting. Stay tuned. There will probably be more on this subject here over the next 6 to 12 months as these things come to market, if they're approved. And I wish you all a good rest of your day.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.